Hello, and welcome to ACC120. This is a recording that's being re-recorded due to some technical issues earlier. So I welcome you to this class. My name is Dr. Vicki Dexter. I am the professor for this class, which is almost totally online. And if you have chosen this type of course, it may be because you have a busy schedule, which is fine. I used to be in the same position, so I totally understand. So you have access to the course in Brightspace, and I have uploaded the course syllabus and the course calendar. I was told on a couple of emails that my information was not correct, but I checked it out and it is. So the date times that you maybe saw when you were registering do not apply because this course, as I said, is totally online except for the 23rd of May, at which time I'll go over that in just a moment. So this is my information, my email, my telephone number. Feel free to text this number for urgent matters. That is perfectly okay. This is one thing that you must do, and that's email me through the CPCC email system. Apparently there are a couple of users that are having issues with their email. Please get with the CPCC technical support for that issue. They're not receiving my emails, so they're not receiving the information about the course. They're also having issues with the textbook. So again, if you're having issues with the textbook, please call CPCC when you have a moment so that you can get that taken care of. I wish I could help, but those are technical issues, and I'm not sure I can help you in that area. So down here we talk about the class meeting day, as I mentioned, May 23rd. We'll be meeting from 6 p.m. to 8:20. This is actually a lecture time and lab time, as if we were in a regular in-person course. We are meeting at the CPCC Cato campus, which is out by the university, I believe. The address is here. This is not required. If it needs to happen, I will set up a alternate day. Perhaps maybe on a Saturday. I'll get input on anyone who cannot attend this day, and we'll go from there. So I will be lecturing and recording the lectures live on Mondays and Thursdays. Mondays for the Tuesday lecture and Thursdays for the Thursday lecture. So if things happen to change, I will let you know in advance. Otherwise, this will be pretty consistent. But likewise, this schedule is possibly open for change. I will, however, always have the lectures available on time for you to review for your homework. I'll let you go through the rest of the information here. Some of the dates I just want to bring to your attention. The last day to drop without record is Monday, this coming Monday, May 22nd. Also by Monday, May 22nd, you should have attended class and completed your EVA assignment in order to get access to the rest of the course. You have to have that completed before I can open up the McGraw-Hill content for you to start working on your homework. The last day to withdraw is June 7th. And then the final exam date is July 17th. So those are important dates to keep in mind. As I mentioned earlier, I'm going to let you go through the rest of the syllabus at your leisure. If you have any questions on it, please let me know. Next thing I want to just look at for just a moment is the calendar. So the days are pretty well lined up. If anything needs to change as we go along, I will certainly let you know. So I mentioned that I will have live recording of the lectures First lecture will be shortly after I complete this little bit of introduction. And then the next lecture will be next week on Monday. So I will record the lecture 2 on Monday so that it's available on Tuesday. And then I will record the chapter 3 lecture on Thursday evening. I do have to do the lectures in the evenings because I do have a day job. This is an adjunct position for me here at CPCC. I'm excited about this opportunity. I enjoy teaching. I have taught for a couple of years, a couple different classes. I did teach this specific course last fall and enjoyed it. I hope you enjoy it as well. So on this calendar, as well as in Brightspace that I'll show you in just a moment, you have everything that is due, when it's due, all in here, all the way through the end of the course. So again, if you have any questions, just let me know. So this is your Brightspace area. So once you come to your course home, you'll see a couple of things here. Over on the right, you'll see the calendar of events, letting you know what is coming up due. Then over here on the left, you have several resources for you to use when you need to. For example, here's the IT that I mentioned earlier, that if you're having issues with your email or obtaining your book, please look at the IT service desk, contact them, and see what they can do to help you. Under your course materials, you have a very important link, which is right here. You don't have to go into the content in Brightspace. Sometimes it's pretty lengthy, but if you go right here to the MH Connect, it's going to open up the McGraw-Hill Connect, and you'll be able to get right to your class. However, when you do go into the content, I'm going to view this as if I were a student. You'll get this Getting Started page. It'll pop up with a couple of things for you to look at. You can, I encourage you to look at the videos that are available there. When you go into the content, you're going to have some sections over here on the right-hand side. You are going to want to start here. The very first thing is your EVA assignment. So you're going to open up that, complete that, and I will be checking every day to see who's completed it every day until Monday. And because I have to actually go in and put your grade in the grade book in order for you to get into the rest of the course. Step number 2 is to explore the course materials, which include the syllabus and the course schedule, which are here. Here is the textbook that you will need. I understand that these links were not working for the people that are having technical issues, but please go ahead and try. And here's technology and help, should you need help. Other help over here as well. Down a little bit further, you're going to have some study groups. If you care to join a study group, these are here to use at your discretion, or if you want to get some people together, feel free to do so. This is totally a resource for you folks to engage with. We also have some discussion boards going on. So there is a discussion area for navigate and engage in discussions for the learner, and you'll see other discussions popping up. Here is my information, and there is a link here to my personal room. So if I decide to have open office hours where I'll just be sitting in front of the computer waiting on people with questions, I will let you know. You will just come here and go right into my room for office hours. In the meantime, however, if you do need help, please send me an email and I'll set up a WebEx meeting for just the two of us. Just let me know what are some good times in the evening or on Saturday or Sunday. I just cannot take calls during the day because I do work during the day. I work for a large bank in the neighborhood, so that keeps me busy Monday through Friday until about 5 o'clock. Then there's some other resources down here for you to explore. So getting back to the McGraw-Hill, which is the most important part, I'm going to view as a student again. So you will have some areas of information, orientation videos, additional student resources you can check out, flash topic videos. So here we get to the assignments. You would just click on it to expand what is underneath. So you will see that your exams are already here. They will open on the start date. So you will have from June 1st to June 4th to complete this part of the first exam, and then also from June 1st to June 4th, the second part of the exam. And then you have 2 other exams after that. This comprehensive problem is very extensive. I encourage you to go in as soon as possible to look at that problem, because it is going to be everything that you learn from start to finish on this course. You do not want to wait until the last minute, because this is 15% of your grade, and it's something that you can do as you go through each chapter, and you will be able to complete the parts of the assignment that correspond with the chapters that we're in. So keep that in mind. And then you get into the chapter assignments. So there are several different things here that are not required, but we do have the Smart Book, which is required. So this will open. This is open today. It will close Friday at 11:59. If ever that you have an issue with meeting a deadline, something has come up other than the dog ate your homework, then perhaps we can talk about it and I can give you an extension. But you do have to tell me in advance before the due date hits, the due date time, because after this time, I cannot reopen it and give you any more extra time. You will then be given whatever grade you have up until that point. But keep in mind that the lowest Smart Book, homework, and quiz grades are removed from the course grades at the end of the course. As far as your grades are concerned, to make sure that you know that you've completed everything, I will not turn that feature on where it does take off the lowest grades until about 10 days before the course ends. Reason being, it gives you a false reading per se, in that it doesn't tell you that yes, you've done it, it's just been dropped. It does not show anything. So many students got very confused with that. So I'm going to leave it on, but just remember, if you get a 0, if you get a low score on something, just remember you already did that one time, you don't want to do it again, and then just go from there. So you have lab work, current events, spotlight videos, static exercises, and static problems that are all very beneficial to you, I encourage you to go into these. They will help with the topics that you're working on, help drive home those categories and things that you need to learn. And then down here you have your homework and your quiz, both with dates. Again, the homework and quiz is open now, and the homework has to be done by Sunday. And then the chapter 1 quiz has to be done by Tuesday. And the chapters are set up the same as we go through the course. So with that said, I am going to start with the lecture 1. Give me one moment, please, trying to set this up properly. So chapter 1, we are going to be talking about business decisions and financial accounting. So one of the reasons that I went into accounting is because it is always going to be. It's always going to be happening in some form or fashion, because even though the way we do accounting changes, especially with the onset of computer use, accounting is always going to be there. Businesses have to have a way of knowing how their business is doing. Banks have to have a way of knowing what their clients are doing. So we're always going to have accounting. There's always going to be a job in some form or fashion in some business in accounting. So that's what we're going to talk about. So the first thing we're going to talk about are the different kinds of organizations that exist in the business world. So we have our sole proprietorship. This is the most common type of business in the US and possibly across the globe. This is a kind of business organization where you as an individual can just put it out there that you're doing this for a fee and pretty much use your own Social Security number. However, I don't recommend that. If you do decide to go into business for yourself, or you have others that are thinking about it, so I suggest that you need to keep your business and personal finances separate. So the first thing you would want to do in a sole proprietorship is get your own EIN number, employer identification number. When you get an employer identification number for a sole proprietorship, it lasts and it stays with you forever. You can change businesses, business name, what you do for a business, anything you like, but because it's a sole proprietorship and you are the owner of that EIN number, that is the number that you would use forever. One of the advantages of a sole proprietorship is, of course, doing things when you want. But you have to keep in mind that you are personally liable for all the debts of the business. A partnership is where two or more people who hopefully know each other well enough to get into a partnership agreement. They are personally liable for all debts of the business. A partnership is created through the IRS and employer identification number. Also, the thing with the identification numbers with partnerships and corporations and limited liability companies is that they stick with the business. If things change, there's paperwork that has to be done to do changes and whatnot. And then lastly, we're going to talk about the corporation. Corporation, of course, is your bigger entities. Most times there are a handful or hundreds of stockholders that have bought stock in the company, allowing the company to grow, allowing the company to build. Whatever it needs to do, it will have stockholders. Going back to the partnership real quick, when two people, and those two people could be a husband and wife, they decide who owns how much of the company. So generally speaking, many partnerships are just 50-50, but it just all depends on what the partners are bringing to the table, how much money they have, how many assets they can contribute, and whatnot. So it's pretty much up to the partners to decide that. In a corporation, stockholders own a certain number of shares of stock in the company that have a certain value. For example, small corporations just getting started, maybe just a couple of people getting together and forming a business, they might sell 1,000 shares of stock at $1 each. And generally, if it's just one person or two people, it's themselves actually putting in that money. So that's the kind of paperwork that has to be done in order to become a corporation. Some individuals who want to go a little bit farther than a sole proprietorship, they will set up a corporation, but tax-wise, they're going to file for recognition as an S Corp, which means that they are only going to be taxed one time because it's pretty much a sole proprietorship with some liability on the company rather than the person for the debts of the corporation. Keep in mind, though, that companies have to establish a good credit history before companies and banks, financial institutions, are going to lend money to the partnership or the corporation or even the sole proprietorship. So in that respect, then the owners usually have to sign a guarantee. So they would be the guarantor for the lending. So essentially, they're going to be liable until the businesses get up and running, have a history, have a good credit history. They are going to be liable until the company can do it on their own. So I mentioned at the beginning that the sole proprietorships are the most common type of business form in the United States. So as you can see, it's 72% of the types of businesses that we have. And then comes corporations. Of course, you have your big companies, your retail outlets, gas stations, franchises, things like that all over. Those are the kinds of corporations that we see across the board. And then we have our partnerships and limited liability companies. Limited liability companies are similar to partnerships, except they are a state form of business, limiting the liability that falls on the owners. So now we're going to get to the accounting system. This involves the operating, investing, and financing activities of the company. And then an accounting system is the way people analyze, record, and summarize the results of the business, like the income that's being brought in or the expenses that are having to be paid for. Most companies exist to earn profits for their stockholders. So they earn profits by selling their services or by products. And an accounting system is an information system for the accountants or managers or the owners to keep up to date so that they can do their taxes at the end of the year, but more importantly, so they know how their business is doing. The accounting system produces two kinds of reports, a financial report and a managerial report. The financial reports are used for external reporting. The managerial reports are used for internal users like managers and supervisors. For example, they may have a forecast and they'll need to know how much product they need to buy. That's very true about restaurants. Every week or every few days, they're looking at their inventory and seeing what they need to order at the end of the week. So those are kinds of reports that they will need. On the financial side, that is going to be for your external users. which are creditors, investors, people of that nature who want to evaluate the company. So these financial statements are very important. On the internal managerial reports, you're going to find detailed financial plans and continually updated reports about the operating performance so they can know where they can make improvements. They also will look at the HR reports, different things like that. Even HR has their own accounting reports. On the financial side, there is a set of financial reports that are generated. We'll talk about those in just a moment. The four main groups of the external users are, as we see here, creditors, investors, but also directors and governments also need to know about the companies. So let's look at the financial statements. This accounting equation, called the basic accounting equation, is something you're going to want to memorize, understand, and just know throughout this course, because this is going to be the crux of all of the homework, all the way through, starting with chapter 1, all the way through to the last chapter. You're going to be dealing with this formula. So your assets equals your liabilities and your stockholders' equity added together. Assets are what the company owns, or money that is owed to the company. Liabilities is what the company owes to others. And then stockholders' equity is the money that has been placed into the company by way of stockholders buying shares of stock, or if it's a sole proprietorship or partnership, it could be just owner's equity, but it's all of the same bucket. It's the money that the people who own the company put into it. So your assets equals your liabilities plus stockholders' equity. Another way to put it is your assets less your liabilities equals your stockholders' equity. But generally speaking, this is how you're going to remember it, because this will come into play when you're doing the balance sheet. So the one thing that we want to know as we go through the assignments for this course is that when we are going through assignments, the information is about one company and one company only. We're not going to get into consolidated companies or companies owning companies, anything like that. So the financial reports of a business are assumed to include only the results of that business's activities. So the resources that the company controls and expects to benefit from in the future are its assets. And that would be the cash, lines of credit, things like that. Line of credit would be a liability, but the cash that's coming in from anything, a loan or something like that, the cash that's coming in is an asset. And then you have your supplies. There's different types of supplies. You could have supplies for the office. You could have supplies for the shop. You could have supplies for a number of different reasons. You have your furniture, and then you have your equipment. Now, these are just 4 examples. A list of assets could be very lengthy. It all depends on how the managers want to see the details and how much detail they want to see. Under the liabilities, these have to be measurable amounts that the company expects to give up in the future to settle what it presently owes to creditors. So that means that loans, credit cards, those kinds of liabilities need to be thought about when trying to build a business. And these include your notes payable, which are simply long-term for loans. Usually notes payable are technically long-term, more than 12 months, because your accounts payable is your short-term. like credit cards and monthly utility bills, things like that. Those are your short-term liabilities. Then you have your stockholders' equity. This is referred to as the owner's claims to the business resources. So what that means is that the owners have put money in the form of stock or in the form of money so that the business can get up and running, so that it can grow or possibly expand. It does not just have to happen at the beginning of a business cycle, at the opening of a business. Companies throughout its lifetime find different things that they would like to raise capital for in order to expand, maybe do renovations in the warehouse, maybe do renovations in the manufacturing equipment. So those kinds of things lead to common stock being sold at various times during a company's life cycle. What is retained earnings? So retained earnings are what is left in the company at the end of a fiscal financial period. For example, most companies are on a fiscal year from January to December. So what happens is they're going to take in sales, and then they're going to reduce those sales by their expenses so that at the end of the year, they want to make sure that they have something left over. So if the revenues are more than the expenses, then there's a net profit. That net profit can stay in the business and be the retained earnings, or some of it can be paid out, or all of it, depending on the owners, can be paid out in the form of dividends if it's a corporation, or distributions if it's a partnership or sole proprietorship. But these things added together, so this one is specifically saying common stock, but there's various different kinds of stock. So there could be various different kinds of stockholders' equity listed, but there's only one retained earnings, and it just builds as the years go by. So your revenues, expenses, and your net income. So your revenues are the sales of goods or services to customer, measured at the amount the business charges the customer. Of course, when they think about pricing, they want to make sure that they charge enough to cover expenses and have some left over. And they want to make sure that they don't charge too little trying to get customers, because they could end up at a loss. Your expenses are, of course, the cost of doing business necessary to earn the revenues, including wages to employees, advertising, insurance, utilities, those kinds of things. There's also food costs, there's also training, there's also accounting work that needs to be paid for. So what happens after, usually companies do it on a monthly basis. They take the revenues for the month, less their expenses, and hopefully they'll come out with a net income, which is a positive. Dividends. We talked about dividends. These are the distributions of the company's retained earnings to its stockholders as a return on their investment. So when stockholders are putting money into a company, they're not doing it just because they want to help most of the time. Most of the time, they want some earnings back on what they've invested. So when they get dividends back, they are not receiving back the value of their common stock. What they are doing is getting a small part of the retained earnings that the company makes at the end of a reporting period. So again, the common stock here really does not change unless the company decides to buy back the stock from its stockholders, or they decide to increase the stock and sell more in order to possibly do those capital improvements. So here again, it's telling you about the revenues less expenses equals your net income, and that's what the profit that is generated. And dividends is the profit that's being dispersed, not the common stock. It's the profit. Dividends are also not an expense. It's just reducing this part of the stockholders' equity on the balance sheet. So these are the financial statements. These are the financial statements and the statements that are used for your external users. Financial statements are typically prepared in this order, and you will see in just a moment that there is a relationship in going from here to here to here to here. However, the order of importance is that the balance sheet, I believe, is the most important of the four, because the balance sheet tells the user exactly where the company sits as far as financially. It can show the user the amount of cash on hand, the amount of outstanding money that is owed to the company. And then it also shows what the liabilities are, what the company owes, and just how well the company is situated. There's also lots of ratios that can be calculated from the balance sheet. We get into those a little later in the course. The next most important statement is the income statement, because this is going to let you know how the operations are doing. And then comes the statement of cash flows or the statement of retained earnings. I kind of put these on the same level because you want to know where your cash is going, and you want to be able to pay out your cash if you have the profits to do so in order to keep your stockholders happy. So let's take a look at the income statement. Noodle Cake Studios is a service entity. So they have sales revenue of $9,000, service revenue of $3,000. Then they have the expenses. But what I want you to know in looking at this is one thing the economists need to do, and other people in industry like to do, is to compare themselves to others. So GAAP accounting calls for consistency in creating these financial statements. So you will always see the header at the top with the name of the company, income statement, and what kind of statement it is. It could be projected, it could be forecasted, it could be actual, it could be budgeted. Just depends on what kind it is. And you, in order to know the net income, it is always the actual numbers that you'll be looking at. So your revenues are always going to be at the top. If it's a manufacturing company or a service company that likes to allocate expenses to the revenues, I apologize, I got interrupted for a moment. So just to reiterate, the top is always going to be your revenues. You may see a middle section with your cost of goods sold or cost of services. And then you're going to see your expenses here, all listed out as you see here. And then there may be another section after the expenses that have other things that are not due to operations per se. For example, interest income, maybe through investments or something like that. It doesn't have anything to do with what the company does traditionally, so it has to have a separate part. So, but generally, you're going to have your revenues first, then your expenses, and then your net income. And this is going to be consistent from company to company, even across borders into the global areas as well. The unit of measure assumption states that the results of business activities should be reported in an appropriate monetary unit. So we have, this is reported in US dollars. Then we have our statement of retained earnings. So if we go back to the income statement, we have our net income. The net income then comes over to the statement of retained earnings. So you have your net income here. You start with a balance, and generally you would only see zero balance in January. But whether it's negative or positive, you add your net income, and because they have $2,000 extra, they've decided to pay out some dividends. So they're paying out half of it in dividends to the stockholders or shareholders or the owners. And then $1,000 is kept in the business and is labeled retained earnings. So this statement reports the way that net income and the distribution of dividends affects the financial position of the company. When you see distribution of dividends, generally that is when there are stockholders, whether it's a partnership, a limited liability company, or a corporation. So proprietorships or some limited liability companies, the distribution of the funds are called distributions rather than dividends. Either way, neither of those outlays of money are considered expenses. It's just a reduction in cash. And that will become more familiar as we get into the course. Thirdly, we have the balance sheet. Like I said, this is, I believe, the most important of the financial statements because this is letting you know how well the company is doing at a moment in time. So again, as we talked about consistency, you're going to see this set up the same way with the name, balance sheet, what kind of balance sheet it is, and the as of date. Let me go back a couple slides and I want to mention this to you. So as we see here, this is for the month ending September 30th. So we can assume that this is for the entire month from September 1st to September 30th. So the income statement is based on a period of time. When we talk about the balance sheet, this is a point in time. This is as of like today. This is from inception through today. So that's why we call it a point in time, and that's why we say at September 30th rather than the month ending. So the assets we talked about are what the company owns. This account receivable, the company owns it, but it's this money that is owed to it from their customers. Then you have the liabilities and stockholders' equity, which is your short-term payables and notes that you owe other people. And then your notes payable, which are your long-term loans. And then your stockholders' equity, the common stock, what the owners have put in. Generally, like I mentioned, this number here does not change unless there is a stock issuance or the company buys back some of the stock. And then your retained earnings is what the company holds back for itself after it pays out distributions or dividends. During the year, you're going to see one more thing under the retained earnings, and that is net income. So as the year is proceeding, then you're going to see net income. This here is saying that there is no retained earnings, so possibly this company just started in September, and that's why there was no beginning balance on the statement of retained earnings. As you notice, these two balances have to be the same. We said that assets equals liabilities plus stockholders' equity, so they have to be the same. And again, this is the order in which you will see it on all financial statements that are done according to GAAP. And then lastly, you have your statement of cash flows. This statement is a little bit harder to understand because it's taking into consideration how cash is used or how cash is brought into the company. So the first one basically is the net income. So you have your cash received by customers and your cash paid to employees and suppliers. So your income less your expenses. So you have your $4,000 in operating activities. Then you may need to invest some money in some equipment and software. So $20,000 is going out the door. And then you have cash flows from financing activities. So this $20,000 usually has to come from somewhere. So it's cash borrowed from the bank. So we have our $20,000 coming in and our $20,000 going out. So this doesn't necessarily mean that it's cash that the company has. It's what's happened to the cash in the bank. So we got a loan for $20,000. We purchased this equipment and software. So we have the $20,000 coming in and the $20,000 going out. And then the other two elements here, we paid the stockholders. So here again is another cash item that's leaving the bank. And then we have received $10,000 because we've issued some stock. So we have our $4,000, and this $20,000 and $20,000 cancel each other out. So we have our $4,000 plus our $10,000, so that's $14,000, less the dividends paid is $13,000. That should be the balance in the checking account at the end of the day. So I mentioned earlier that there are relationships between the financial statements. So this first one, the net income, is $2,000. So it's what is taken to the statement of retained earnings. So then after we do the statement of retained earnings, we get to the balance sheet, and you can see the retained earnings here. So once you have your net income, you've paid out your dividends or distributions, you have your $1,000 left, you're going to see that on the balance sheet. And then we talked about our cash. So our cash activities came down to $13,000. We look at our cash balance and it comes to $13,000. So now I'm going to help you understand how statements are used by decision makers. So I wanted to express how important financial statements are and knowing how to read them. So when I was working on my doctorate degree, I chose to focus on small business owners and their success. My philosophy was that if business owners knew how to read their financial statements and they had some understanding of what they mean, that they are more successful. And thankfully, I was able to prove that using two different populations. I used a population here in Charlotte, Mecklenburg County, as opposed to York County in South Carolina. Of course, we know that Mecklenburg County is pretty large. It's got the big city of Charlotte, so there's a lot of business owners up here. In York County, much smaller, a lot more rural than this area up here, so there's a lot less business owners down there. However, when going through my studies and my research, I was able to point out that yes, business owners are more successful if they know how to read their financial statements. So if you decide to go into business or you have friends, relatives, whatever, make sure they get an understanding of financial statements so they can keep on top of their money and know where it's going and how it's coming in. And this is one reason why, because financial statements are used for a couple of different groups of people, your creditors and your investors. So the creditors are going to ask, is the company generating enough cash to pay what it owes? So they're going to want to look at the cash flow statement. And does the company have enough assets to cover its liabilities? So then they're going to ask for the balance sheet. Your investors ask questions like, what is the immediate return on my contributions? And the return is through receiving dividends. So more than likely, investors are not looking to give money to just anybody to let them use their money for nothing. Usually they're doing it for a return. They want to make money on the money that they have given the company to use. So the dividends are going to be important. And then what is the long-term return through stock price increases resulting from the company's profits? They want to know the history. A good investor is not going to look at just the last month or just the last few months on a company. It's going to look at the last many years, because stock prices are going to go up and down. That's just the way the business rolls. There are seasonal issues. There are issues with weather. There are other kinds of issues in the economy, and they want to see if the prices drop, how quick are they to come back up? So that's the life cycle of businesses, where their stock prices, you want to see it go like this. You don't want to see it go like this, down and then get back up, down and then back up. You want to see it a consistent going up and down. More ups than downs, but you want to see the slope going this way rather than this way, or definitely not this way. So if you were looking at the graphs. So what statements are we going to use here? The statement of retained earnings and the income statement. Then there are factors that contribute to the useful financial information. We want to provide useful financial information for external users for decision making. Useful how? The main goal of financial reporting is to ensure companies produce financial information that is useful to present to potential investors, lenders, and other creditors in making decisions. The information has to be relevant. It has to do with what they are doing to earn the money. So the financial statements have to be clearly understood. You have to have expenses that are clearly labeled as to what they are. You have to have income that's clearly labeled, and it has to be relevant to what they're doing. Faithful representation means they have to be accurate. They have to be true. Sometimes banks will require audited financial statements. And then there's these other 4 characteristics of the financial statements. You want to make sure they're timely. Companies, investors, they're not going to want statements or tax returns from 2 or 3 years ago. They want them from the past period of months. Usually the past quarters, things like that, has to be verifiable. The information has to be something that an auditor, an accountant, IRS agent, anyone can go in and verify, yes, I see these deposits going into the bank. I see these invoices being paid. I see these sales coming in. So it has to be verifiable. It has to be something that people can see and flow through the accounting. And that's why it's important to keep receipts, keep statements, keep everything. And now with technology, it's very easy just to snap a picture, put it in your phone, upload it to your accounting software, and boom, it's done. The information has to be comparable, especially if you are in a market where there are a lot of competitors. And that's why the financial statements have to be in the right format to be comparable. And that's why, generally speaking, you're always going to see your income statement, income, expenses, net income. You're always going to see your statement of retained earnings with your income, dividends, or distributions, and then your retained earnings of what's left over. Your balance sheet is always going to have the assets at the top, then your liabilities, then your stockholders' equity. Sometimes you might see the assets over here and the liabilities on top over here with the equity underneath. That's fine. It's still in the same way. And since you're looking at me from that way, you're probably going to see the assets on this side and the liabilities and equity on this side, but I think you get the idea. And then lastly, it has to be understandable. You have to use terms, you have to use categories that people understand. They're not in your business, they're not in your market. If they invest in your company, they're going to want to know a little bit about your company, about what you're doing. But when it comes to reporting, you want to help them understand better by using terminology that helps them to know what's coming in and how, what's going out and for what. So accounting standards. We go by GAAP here in the US, but there's a organization in the middle called the Financial Accounting Standards Board who set the GAAP, which is generally accepted accounting principles. And that's here in the US. So we have the United States is the where, the who is the governing body, and the what, and that's the GAAP. Those are the principles that guide what accountants do. Is it law? Do company books have to be done the same way? No. However, if a private company doesn't want to follow GAAP, that's fine. I worked for a company that was private. They did not have shares of stock. They did not have any owners except for the family ownership. It was basically owned by a mom and dad, and their children worked for them. So it was private. They could basically ask for their financial statements to be set up how they wanted them to be. And we had what we called YAP. So it was the Y accepted accounting principles. So anyway, if a company sells stock, if it's stock that's sold on the exchanges, then they have to follow GAAP. It's the rules that they have to follow in order to be in sync with the Security and Exchange Commission, the SEC. All right, then we have the world. What's going on globally? So accounting goes on everywhere. We know that. We know there are businesses everywhere. We often fly there. We often have partnerships there. We often have companies that have companies everywhere. So the International Accounting Standards Board was created to help make things a little more consistent across the globe. Slowly but surely, FASB and IASB is coming close. I don't know that we will ever be the same on board with everything that we think and everything that we do as far as our GAAP accounting, but I think we're getting pretty close. And that's just my opinion. However, IASB are in charge of the International Financial Reporting Standards, and that's what the IFRS stands for, International Financial Reporting Standards. Very, very important subject, being ethical. So when you're faced with an ethical dilemma, what do? So this should help you understand what people face on day to day, because when you're in accounting, you're dealing with money, and let's face it, money is something that kind of leads people down the wrong path at times. And so you're faced with Do you want to be loyal to your employer, or do you want to do the right thing, the legal thing? So the first thing you want to think about is identify who will be affected by the situation. Is it going to be just you, or is it going to be the people you work with? Is it going to be obviously your managers? Then you want to identify and evaluate the alternative courses of action. And then choose the alternative that is the most ethical. A lot of times we don't know. We don't know which way to turn. So we want to ask. We want to reach out to people. There are situations, many situations where accountants, auditors, and managers weigh the pros and cons of alternatives before making decisions to help make sure that decisions are professional and done in an ethical manner. So that ends the lecture for this evening. If you have any questions about the lecture, please feel free to send me an email. Or if you want to carry on a conversation with your classmates, please go ahead and create a chat in the dialog box. If you have any questions about how to set that up, I can help you with that as well. In the meantime, remember your homework is due. You have a smart book that's due as well as, but first make sure and get your EVA done so that I can open up the rest of the material for you. Thank you, and y'all have a great week. I look forward to helping you along this journey of learning financial accounting.